All right. Well, again, thank you for taking the time to come in and try our virtual session here on this Saturday. So what we're going to try and accomplish in about the next hour and 30 to hour and 45 minutes is go over homework one, talk about what we need to focus on this week for economic statement conversion. I'll again reference the video files that are available online right now, both on Canvas and on YouTube. And then we'll talk about setting up homework two. Just to go over an administrative item that I had mentioned in an announcement. I know last week we talked about possibly doing a webinar for the July 6th session. So we're not going to do the break week. I think it'll be too difficult for everybody to move their schedules around. So based on how this goes, we'll talk next Saturday about in person whether or not we want to try this on July 6th as virtual or whether or not we want to do this in class. Right now, for some reason, my webcam is not being enabled. When I was using it for YouTube earlier, YouTube hijacked my webcam and it won't give it back to me. And the only way I can fix it is to reboot my machine, which will end the meeting, and it seems to be very disruptive. So at this point, we are just going to use screen sharing, although I can see any of you that have your videos enabled, and particularly for the classroom, if anybody has a question, I want to make sure that we make this a two-way dialogue as we go through some of the material. So with that in mind, the other thing I want to mention is groups. Because we're virtual and don't have a lot of time, we will finalize groups next Saturday during the July 15th class. So if you're not in a group by next Saturday, I will put you in a group. So you have between now and then to sign up for your groups. And again, at the beginning of next Saturday's class, we'll announce the industry. Again, it's going to be construction. You'll be able to figure out which company you want to do the valuation on. And then we'll talk a little bit more about that group project. So that'll be the other thing we'll try and accomplish next Saturday. Right? So as we get started today, I wanted to first go over kind of homework one, which was due today. And so as part of homework one, what I wanted you to focus on was really what I'll call the Eic assignment. And this is going to be one of the 4 parts of your group project and a key part of any analysis. So again, a good chunk, probably about 50% of a company's performance can be based on these external factors. So it will help us when we do the valuation and evaluation of a company. So relative to Smithfield Foods, I chose them as a company for the Eic because they are being taken over, if you're not aware, by a Chinese company, and it will be the largest acquisition by a Chinese company of somebody here in the US. And so those are some interesting valuation issues. But regardless, we want to talk about sort of the food industry. So for the first part of the economic analysis, and again, because we don't have a lot of Bloomberg terminals in DC, I gave you the screenshots for this exercise. And so we want to look at their beta. And so if I look at their beta, go to screenshot that I have, then basically Smithfield Foods has a raw beta. We're saying we're using raw beta this semester of 1.3. So somebody want to give me a answer to how sensitive Smithfield Foods is going to be to the economy? You're going to jump in for this one? I think all your microphones are live. So including anybody on that is dialed in from home.
Professor, I can answer the question.
Should be pretty sensitive, should be more sensitive than the overall market.
Yes. So for the people that are actually in the classroom, once you get beyond the first row, the microphone isn't going to be sensitive enough for you to hear me. So I don't know if you want to ask any questions, you're going to have to kind of move to the front or at least walk to the front if you have a specific question. Because like I said, I can see the classroom, but it's going to be hard to hear. But yeah, exactly. So when I grade this and ultimately do your valuations, the key is going to be that Smithfield Foods has much more sensitivity to changes in the market, which means that also eventually when we start forecasting our cash flows, we probably don't want to predict a straight line because in better times, they're probably going to have better performance, and in worse times, they're going to have worse performance. So it starts to also give us some sense of cyclicality of the type of a business. So interesting that Smithfield Foods is considered, a little bit more risky than probably the average company, and they're in an industry which is food, which most people wouldn't consider to be very risky. So what's going to be key to the E part of the analysis is talking about the general direction of the economy, and probably given the current LEI, looks like it's getting stronger in the second half of the year. And so Smithfield Foods should really benefit from that, regardless of the acquisition premium that's been put into play. So that's what's going to be key to the E analysis. All right. So the next part of your assignment was to do the I, which was the 5 forces. Now, as we do the I, we're going to start out with the RV screen on Bloomberg. And what's going to be key to this is that we are going to, and we'll talk more about this. Again, I'll try to do this once more as an example of another company in class next week. But we're going to use Bloomberg to give us an industry spread. So one of the features of Bloomberg is that you are able to create custom reports. So in this case, I've created a custom report that has return on invested capital and WACC on the screen. By definition, Bloomberg will give you a series of companies, and then you can do a weighted average. So basically, at an industry level, if we look at Smithfield Foods industry, they are currently earning a 9.3% ROIC in an industry whose cost of capital is around 6.4. So this is what we're going to use to define industry attractiveness. And so ultimately, when we do the analysis for the 5 forces, this is going to determine the overall score. So basically, the 5-point scale that we're using for our analysis in this class is made up and arbitrary. And the definition that we're going to use for a 3 is basically earning an average cost of capital rate of return. So basically, a break-even spread would be a 3. Anything that gives you better than a break-even spread, earning a higher rate of return, is a 4 or 5. And anything that hurts your ability to earn a 6.4% in this case, cost of capital, anything that hurts your ability to do that would be a 1 or a 2. And so that's the way that we want to think about this analysis and think about the industry. So the key point here is that when you're answering the 5 forces question, you're thinking about the industry, that the overall value today is an observed value. So it's not your opinion on whether you think it's a good industry. It's looking at the actual financial performance of the industry. And so right now, Smithfield is in a good industry currently. And so the key is we want to go through the 5 forces and try and explain why. Then we want to talk about how that will change over the next 5 years. And then that will infer a new overall score. So really, it's just a way of predicting what we think is going to happen at the industry level for return on invested capital. And instead of directly predicting the number, we're going to use the changes in the 5 forces to basically do it. And the other thing I'll just make as an observation as you do 5 forces analysis is it's not each force has an equal weight. So, for example, we could say for certain industries that supplier power may be not substantial at all. And so even though we give it a lower or high score, it won't really impact the industry ROIC. But in other industries, supplier power could be everything. So we also have to make a little bit of a judgment on which factors are more important. So in context of Smithfield Foods, in terms of doing your analysis, one of the things I'm going to be looking for is that you're going to have to tell me Smithfield Foods is in an attractive industry based on this data. So if we were scoring it on a 5-point scale, then basically you should be giving it a score above 3. And so in this case, probably looking at maybe a 3.5 or 4 if I look at 9.3% against a 6.4% cost of capital. And so again, when we do the 5 forces, it's the industry that the company is in, not necessarily whether it's an attractive company itself. That's what we're going to be talking about with competitive advantage. I'm just pause here for a second and see if anybody had any questions.
Yeah. Can you hear me?
Barely.
Okay, I'll try. So, Roy, I'll speak up. I guess my question involves like industry attractiveness, and when I did it, I was looking at the spread between the ROIC and the WACC,
Yes.
and seeing that the spread was just under 3%, I thought it was kind of a slightly unattractive industry.
Well, and that's a reasonable point, except the way that we want to interpret it here is that from an investor standpoint, the whole idea of a WACC or cost of capital says this is a fair return for the risk that I'm taking. So from an investor standpoint, if I get a 6.4% rate of return, I should actually be reasonably satisfied because I took a risk to get 6.4 and I'm actually getting 6.4. So the way to interpret it is not, hey, 9 doesn't sound good when other industries are making 10, 15, but given that for this level of risk, they are expecting on an opportunity cost basis 6, then 9 is much better than 6 for this level of risk. So I think that's the way that we're going to want to interpret it here.
Okay, so basically the bigger the spread, then the more favorable the industry is.
That would be the idea. So in order to have a favorable industry, it has to have a positive spread. And an unfavorable industry would have a negative spread. So, and it might be helpful. Let me see if I can get into Bloomberg here. So I got a lot going on my screen. To just look at a couple of different industries to kind of help get a comparison on this. Sorry, just loading the Bloomberg terminal here. But, and you can actually see on my screen that one of the companies I was thinking about us doing an evaluation on was Google. Let's see if I got kicked out of Bloomberg, probably. Log, oh, no, not German. That would be bad. Let me log in. So just to give an example of this, picking a different industry. If I look at, and one of the companies we were talking about last semester with my undergrads was Rio Tinto, the mining company. And so if I look up Rio Tinto, and so again, as you start using Bloomberg, you have to understand that the Bloomberg terminal systems were developed in the 1980s. And although they have developed a little bit better version since then, they're still text-based systems rather than GUI interfaces. So, and they just stayed in over time. But one of the things that you'll start to use is the concept of a short code. So when you type in, probably useful to mention this here, if I type in a company, so I can start typing in their name or their ticker symbol, Bloomberg will filter out the companies available here for the securities. Again, equity is the stock. If you ever see Corp, it's the company's debt, because again, Bloomberg's a big fixed income service. In this case, they trade in different stock exchanges. LN is London, and that's where they're headquartered. So we'll look on the London exchange. And then this will bring you to a submenu of some specific areas of Bloomberg that you can analyze the equity on. There's obviously a lot more, but one of the things that we're going to use a lot is called the RV screen. It stands for relative value. And this allows you to compare many different ratios for a company against their peers. Now, and I mentioned this in the last video, but basically by default, Bloomberg has the ability to do peer lists at a different level. So in this case, it's using the Global Industry Classification Service as opposed to different ways of comparing them. What we're going to do, just for simplicity, is use what's called the Bloomberg comps. And the difference in the peer list is that the GICS goes by industry standard codes. The Bloomberg comps is an analyst at Bloomberg who's gone through and selected who they think are the appropriate peers. Now, the nice thing is if you choose the Bloomberg comp list, there is an ability to come down here and edit the list so that if I want to remove or add somebody from the list, I can do it. So for example, if I wanted to add a company like Google, it was just on the screen, I type in their ticker symbol here, I would choose them and it would add them to this list. And if I wanted to delete them, I just uncheck them, save it, and they'll be gone from the list. But in this case, I'm going to discard my changes. And one of the features we're going to use in this class is under custom. And so they have a series of predefined templates that you'll see and get used to in a number of tabs. And if you go to the custom tab, you can create your own predefined templates. So in this case, you can add a column, which is pretty much any field within Bloomberg, or create your own. And in this case, one of the fields we're going to look at is return on invested capital, ROIC. So I'm going to select ROIC. And in this case, I'm going to do it based on the latest year. And then I'm going to hit the enter key. You can add the ROIC for all those companies. Then I'm going to add WACC. And it's just one WACC, which is the current WACC by default. Hit enter, and I have my WACC. And so what I can then do is I can then take this template and I can save this template, and I can call this 760 spread template. Spread template. And, well, thought I could. 760. Well, it's called 760 spread. Hit save. And it'll be here as a predefined custom template. But the nice thing is when I go to different companies, it'll always remember this template. The other thing we can do is under select stats, I can choose some simple financial analysis to do to this. I'm going to do a market cap weighted average because I want to kind of weight the companies that are doing better by market cap. And so basically it'll give me an industry average based on the peers, right? So in this case, if I were to look at these peers, now obviously we're missing some data here in the current fiscal year, and I don't know why without some further investigation, but this would be an attractive industry because this industry, at least these players on weighted average basis, and most of it's BHP, are earning a really good rate of return against a cost of capital. But let's pick a different industry. Somebody give me a suggestion. Any other industry? Cisco. So we can look at Cisco's peers. So as a company, look at networking. So I can go to Cisco. I can type in RV. I can quickly go to the Bloomberg peers for communication equipment. And then I can go back to custom, and the template that I just created is saved and then repopulated with all the data. So basically, if I then, it's the one feature you can't save, if I then put back the market cap weighted average, I can see that Cisco networking industry, so really it's more the networking industry, is earning about 22, 23% in an 8.9% cost of capital. So again, an extremely attractive industry. Historically, an industry that hasn't been performing well is airlines. So in this case, I'll pick an airline, look at Delta. I can then go to RV. And again, if I look at the Bloomberg peers, and if I go back to my custom template, then we can see on a weighted average basis that right now the airlines are actually doing really well. Baggage fees have been a complete differentiator to the industry. As a matter of fact, when we think about competitive advantage, since we're on the screen, the way that you should be thinking about competitive advantage is basically how a company is doing relative to the industry. So in this case, and I'm sure you've probably done case studies of this in other classes, Southwest is underperforming the industry, earning a horrible rate of return, has a negative spread, and financially has no competitive advantage. And they've really fallen far in the last 5 years from the preeminent airline on a financial basis. The primary reason for this, by the way, is the fact that Southwest Airlines doesn't charge fees, and all the other airlines do. And right now, over half the industry profit is coming from the fees they charge. And that is why Southwest is actually not earning reasonable rates of return. So the point is, when we say industry, attractive industry. When we say competitive advantage, Southwest Airlines would lack competitive advantage. Right now, Delta, US Air, Alaska, Spirit, and Allegiant all have competitive advantage. They're all doing something that's giving them the ability to earn a better rate of return. Although right now, Delta in the industry, which you remember combined with Northwest a couple of years ago, is actually right now the top performer. They're getting the best return in a good industry and doing even better than the industry average. So Delta must be doing something right. And so what we want to do is kind of take the numbers and back into competitive advantage, back into industry analysis, rather than going the other way around. So that's what we're going to be focused on when we do this analysis. Again, I'll pause.
Yeah, Professor Perfetti, can you hear me okay?
Yes.
So one of the questions I think the other students were getting at this was that, yeah, there's definitely an excess return. There's a spread over the WACC here, but it seemed sort of marginal. So we've been talking about attractive industries, and you see something like a spread, 10% over the cost of WACC, and this was more like 3% on a pretty low number. There was kind of a lot of spread among various companies. I think like Hormel had a dramatically different return than some of the others.
Yep.
So sort of, is there kind of a margin of error within which you say, yeah, you're creating spread, but it's sort of fragile enough that this could be overturned by a cycle, or this could be a weather effect or something like that, that we're not necessarily going to call it an effect, or is it just like if it's above, they're earning more than the WACC demands, and that's all sort of incorporated there?
Sure. I think that's actually why, and that's a great point. That's actually why I asked you guys to do a write-up on the 5 forces analysis, because that's really what you should be talking about in your write-up. So for homework 1, if I looked at a company and I said, I think that Tyson has slight performance, but as you said, I don't know if it's sustainable. And that's where you're going to give your point of view and opinion. But at least as a starting point, I want to start out with the idea of competitive advantage. I want to start out with the idea of industry attractiveness using real data rather than sort of informed opinions. And so essentially, the definition that I want to use in this class is that in order to justify advantage, you have to earn better returns than your peers. In order to have an attractive industry, you have to out-earn your cost of capital. So that's why we also are doing the 5-year point. So we have to talk about, it's fragile. And oh, by the way, in 5 years, it's going to be less fragile. Or in 5 years, it might be more fragile, and we think it's actually going to get worse. And again, it's just sort of the structured approach that we want to take. Okay. All right. So in the interest of time, I'm going to move forward from the EIC. I'll give you individual feedback as I grade your assignment, but that's really what I'm going to be looking for. Did you kind of go through that process? Did you give sort of a rationale or a point of view? And did it help you predict what the returns were going to be in 5 years, and ultimately whether or not a company had competitive advantage and what you think about what's going to happen in the future? Because ultimately, that's the process that you're going to use. In terms of this week, we're going to be focusing on the economic statement conversion and the valuation. So again, what I had done is in the spring, I'd lecture captured all of this content, and I made that available online due to our abbreviated session. And so I'm really just going to focus on some of the key issues, and all of the slides are in great detail. So there's 2 one-hour videos that are both on YouTube and on Canvas, which go through all of the content in the economic conversion and most of what's in lecture 2. So again, I'll leave the details for there, but you'll definitely need to look at those if you need assistance with this week's assignment. But ultimately, a couple highlights from the lecture notes I wanted to mention. So this semester, there's many different methods for doing valuation, and the book highlights them. This semester, we're going to focus on 2. So we're going to focus on an enterprise DCF model and what's called a discounted economic profit model. And the important thing is that the value of a company should not change as we change our valuation methodology, because the value of the company is the value of the company. And so all of these models should essentially give you a very similar answer, if not the same answer. And that's one of the things that we're going to show this semester, is that I'm going to hold you responsible for these first 2 models. Your final exam, be very transparent, is going to be basically, I'm going to give you some data, give you some assumptions for evaluation, and you have to prove that these models give you an identical answer. It's going to be half your final exam. Right. And so basically we're going to use both models and value companies using both models. The other reason for using the second model, by the way, the discounted economic profit, is it gives us some additional insight that the first model doesn't. And that's one of the other things we're going to focus on with the economic profit, or what's often called the EVA model, economic value added. So to give you a sense of what we're going to try and accomplish, me just jump straight to this slide, this is actually a very important slide because when we build out our valuation models, this is going to become one of the tabs in our valuation model. And the book went through an example of a Home Depot valuation, and this is a discounted cash flow valuation of Home Depot. And again, we're going to use the exact same process when we value companies. So the idea is that value is based on free cash flow. So in a sense, what we're going to do is we're going to split up the value of a company into 4 areas. And that was the other sort of key component of the process that we're going to go through. And one of the first areas that we're going to look at is called the operating value of a firm. So in this case, we're going to look at the operating value, which is the sum of the future free cash flows, by forecasting out the free cash flows. So in this case, McKinsey did a forecast for Home Depot's free cash flows for 9 years. And they individually forecasted each of the free cash flows. But then it became too difficult to forecast the free cash flows. So what we do is we create what's called a continuing value period. So we have kind of 2 major periods for valuation. One where we forecast year by year, and then 2, we proxy out the long term using a continuing value formula. Now, the continuing value formula that we're going to use this semester is actually the key value drivers formula that we had talked about last week and that they talked about in the book. So these are going to be the key value drivers that help us forecast out the continuing value. So using some assumptions for no plat in the future, growth in the future, ROIC in the future, and a cost of capital for the industry, they basically said from year 2019 forward, Home Depot's worth an additional $92 billion. We're going to estimate a WACC, and then we're going to discount all of those free cash flows back to a present value. We're going to sum them up, and that's going to be basically the operating value of a firm. So in this case, when McKinsey did this valuation, the operating value of Home Depot was $62,694. That was their estimate based on the assumptions of these cash flows coming through at that cost of capital. Now, this is a process that we're going to skip, but McKinsey also included the idea of a mid-year adjustment factor. I'm not saying it wouldn't be useful to do in your models, but since we have such a short class for this 2-credit class in the summer, there are a couple of shortcuts we're going to take. But the point of the mid-year adjustment factor is that when you do a present value, you're taking the value of a cash flow in December 31st, and you're bringing it back to January 1st. Well, Home Depot doesn't earn all of this free cash flow in December 31st. They're earning it throughout the year. So by using a mid-year adjustment factor, what it basically says is if they earn an average rate of cash flow out throughout the year, then it's like earning the cash flow on July 1st. So what they do is they take basically 0.5 power of the discount rate and basically say that that's the extra value of moving the entire valuation forward by 6 months. And so that's what the mid-year adjustment factor is. So we're worth $62.6 billion if all of the cash came on December 31st. But if the cash came out on an average basis throughout the year, June 30th, July 1st, then really on a present value basis, we're worth 65. Right? So that's the idea of the adjustment factor. Again, we're probably going to end up skipping that step. Now, from there, we then want to add in our non-operating values. And then we'll take the non-operating values, add them in to get an enterprise value. So operating plus non-operating equals enterprise value. We then pay off all the debt, interest-bearing debt, and debt equivalents. And debt equivalents are going to be very important because Home Depot leases a lot of stores. And leases, until the accounting bodies change it, can be off-balance sheet items. So we need the debt and the hidden debt. In this case, it was $8.3 billion for Home Depot. So about $19 billion of debt and hidden debt that had to be paid off before shareholders are going to get paid. Subtract that from the enterprise value. What's left is equity value divided by share equals share price. Pretty straightforward methodology. So method number 2 is the economic profit method. And here's what's different. Instead of forecasting free cash flows, we forecast economic profits. 2 ways to do economic profit, or EVA is often what it's called. But the simple way is we take the capital that the firm has employed, which we will forecast, And then we take the spread that we forecast for the firm, the ROIC against its cost of capital. The spread times the capital is the economic profit. Right? So since they had a slight negative spread in this year, take a negative 0.5 times that number, that's the negative 164. So economic profit is change in value during a period of time. So what we're really doing in the economic profit valuation model is we're forecasting out changes in value. Now, we use the same discount factor, same cost of capital, in both models, economic profit and DCF. And we also use the same cost of capital over the life of the company because we're making an assumption that the company's capital structure isn't going to change. So if the company essentially is managing to a target capital structure that doesn't change, then the cost of capital is not going to change. And it's primarily for simplicity. So therefore, we present value the economic profits. So the economic profits in the first 9 years, change in value in the first 9 years, in a sense. We have the change in value or economic profits in 2019 into continuing value, present value that, add it up. This is the operating value change of the business by basically running what they do. We add that to what was originally invested, or the starting invested capital at the end of 2008, and that gets us the value of the firm. Now notice that this number, 62,694, should sound familiar to you because it's identical to this number, which is 62,694, which was the DCF operating value of the firm. And that's back to the point of, if you do a different valuation, you should actually get the same result regardless of your methodology. So if I did the spread method, then I get the same answer as if I do the DCF. And you might wonder, well, gee, if I get the same answer, why do I need to do both methods? And part of the answer is insight. So if we think about Home Depot here, when McKinsey did the valuation, their operations are worth 62,694 based on the projected cash that they earn. That's an important number. But here's a question that I can't answer with the DCF, which is, how much did I have to spend as an investor / Home Depot to generate the 62,694? How much cash did I have to give Home Depot? And did they generate more value from that cash than I gave them? And just looking at a DCF, I can't understand that question. And so, for example, this is called market value added. Some organizations can create value just because they spend more money. And some organizations create value because what they spent, they do a lot with. And we want to be able to distinguish between the two. So when I look at the economic profit valuation, what I know is that investors gave Home Depot $37 billion, and they took this $37 billion, put it to work, and incrementally created $25.6 billion of extra value. And so the two together, the value of the current business, the assets in place, plus that incremental change in value, because they consistently earn a positive spread over time, gets me to a value of 62,694. So by using the economic profit model, it gives me that insight that they have added value, or what's called market value added, or MVA, of $25.6 billion. Again, I'll pause to see if there's a question about any of that.
This is Morteza. Question. Can you hear me, Professor?
Yes, please go ahead.
Yes, I can see a lot of similarities between this method and residual income method. I wanted to ask if clean surplus violation would be also an issue with this one. I'm sorry I'm jumping too much ahead, but I just wanted to know if clean surplus violation is also an issue with this one as it is with residual income.
You're saying clean surplus violation?
Yeah.
Sorry.
Because I can see that we are forecasting the invested capital here, so probably equity is increasing based on the amount of the amount of net income that we would not distribute to equity holders.
Yeah, so that gets, and so let me just answer your question more simply and focus on this model, which is, that's the point. Because if I, as a company, am just earning a lot of profits and retaining them in the business, and that's making me more valuable, then this to some degree differentiates it. Because if I keep retaining that capital, then theoretically my invested capital could grow. Now, I'll say theoretically because what McKinsey has done and what we're going to do in the book and practice at our class is we're actually going to handle it differently. So what I mean by that is that the cash that you generate is going to go into excess cash and non-operating value. So by using the method that we're actually going to do, what it's going to do is it's going to strip out that impact. And when we say invested capital, it's going to be what's called operating invested capital, which is what's being really used to generate the value of the business. So it's less to do with the equity that you have in the business and more to do with the cash that you're investing in your assets. So we can actually account for that with the model that we're about to use. But the key is a company could still do that. They could still be putting money into assets and trying to make them valuable just because they own more stuff, not because they're doing a better job with the stuff that they own. And that's going to be a key point. And you'll get a better sense of this when we get to the economic conversion in just a couple of minutes. And again, I'm kind of running through this relatively quickly.
Okay, all right. Thank you.
But I will say that by valuing the non-operating assets, and cash is a non-operating asset, which in a way is a proxy for the retained earnings of the business, then basically by stripping them out and calling them non-operating, we do try and adjust for that with this method. There is one other method that I did mention in the video called APV. And the one thing I just want to mention about APV is that if you ever do an APV model, stands for adjusted present value, this is what, for example, a private equity firm would be doing right now with Dell computers or thinking about taking them private, is that you're basically trying to value the impact of what's called the interest tax shield. Because our government basically subsidizes debt, as do many other governments, by allowing debt to be tax deductible, equity is not, then basically we have an advantage to having debt when we have fairly high tax rates. So the whole point of doing an APV model is it actually lets you figure out the value of the tax shields, or pretty much the value of having debt in your capital structure. So for example, to do an APV, you forecast the same free cash flows that you do in the DCF model, but you also forecast how much tax shield you get. And the tax shield is basically going to be the interest expense times the tax rate, because that's what you're going to be able to deduct. We then discount it at not the WACC, but at a cost of equity, a higher cost of equity than the WACC. So it's a higher discount rate. Gets us a present value of the cash flows and a present value of the tax shields. We add them up, and it gets the same operating value of the firm. So the reason why the APV model is useful is it gives us insight into what's the value of Home Depot having debt in their capital structure. So if Home Depot were debt-free, they would only be worth $53 billion. Because they're not debt-free and the government subsidizes the debt, they're worth $62 billion. So they have actually increased the operating value of their firm by $9.4 billion because of the government tax shield that they have. So it's a very specialized model, and the whole point of the model is to figure out the value of the debt. And ultimately, what it's primarily used for is, again, if I'm the private equity firm thinking about acquiring Dell, I want to maximize my tax shields without having my cost of capital get too high as I have more debt, dealing with bankruptcy and other risks. So basically, they start to run simulations to figure out what an optimal capital structure could potentially be. But it's a very narrow model because it gives you the same answers as the other models, but it doesn't really give you insight into why you're creating value. It really just gives you the value of the tax shields. But that's the point. 3 models, 3 perspectives. DCF, what's the value of the firm? Economic profit, how much value was added to what was spent? APV, what's the value of the tax shield in the capital structure? Again, because we're doing a very short class this semester, ultimately, I'm just going to focus on the first 2 in the interest of time. So going forward, this is where we're going to end up. We're going to end up with the valuations. And very quickly, in a few weeks, you're going to be doing these valuations of the companies. So the whole point of the process is to do this valuation. We need to know what the free cash flow is. And to do the valuation, we need to know what the future economic profits are. So that's what the economic statement conversion process is about. Unfortunately, what happens in the real world is economic statements are based on cash flow. And what we've now done is we take cash flow and we turn them into accounting statements, which have nothing to do with cash. And most of our time here is going to be spent taking accounting statements and turning them back into economic statements, which help us get better insight into cash. So really, that's why we convert the statements, because we have to take the accounting statements and turn them into economic statements so that we can turn the statements back into a cash flow based forecast. So we can essentially do a glorified NPV. All right, so now let's get to the very core important stuff for this semester. This graphic, by the end of the semester, should be burned into the back of your brain. And understanding this graphic is key to understanding the process that we're going to go through. So basically, this is a graphical representation of Modigliani-Miller. And so the idea is a company's worth the sum of its future cash flows. And what we're going to do is we're going to call these cash flows operating cash flows and non-operating cash flows. And we're going to separate the cash flows into those two buckets. We're going to value them separately, and then we're going to add the two together to get the enterprise value. So for example, last weekend when we were talking about Molson Coors, what I told you is the average rate of return for both of these buckets together was well below their cost of capital. But the rate of return for the operating activities was far different than the non-operating activities. And so what we want to do is have a little bit more granularity between the two. So operating cash flows are primarily the cash flows that come from customers doing the normal business of the business. And the key to operating cash flows is when the customer volumes change, the operating cash flows will change. Non-operating cash flows are cash flows from everything else. So they're independent of the customer. They're independent of the volume of the firm. They will change at a different rate. And so by forecasting them separately, we can forecast the cash flow rate of change separately and ultimately the returns in the cash flow separately. But we will still value both, add them together to get our enterprise value. So as a mnemonic device, we're going to label these 4 boxes with numbers. And this is just format that will help you. This is not in the book. So the reason that this number format that I'm about to give you came about is I used to be a training person in the analyst training program for McKinsey, and they had to learn very quickly how to take their analysts that were coming out of college and get them to work on their valuation models. So I came up with this mnemonic as a quick way to help translate these statements. So everything I'm about to do with these numbers, 1, 2, 3, 4, that we're about to talk about, is Joe's method. And if you try and search it on Google, you're not going to find it anywhere else. So I'm just trying to give it to you as a way that it has helped me help other people quickly understand the model. So as I said, think about each of these as a box, and we're going to call the operating cash flows box 1, right? We're going to call the non-operating cash flows box 2. 1 plus 2, operating plus non-operating, equals enterprise value. And that's the cash that you can distribute to the debt and the equity holders. All the cash flows to the debt holders, box 3. All the cash flow to the equity holders, box 4. 1 plus 2 equals 3 plus 4. So debt and equity cash flows are enterprise value. Operating and non-operating cash flows are enterprise value. And so again, there has to be an equivalent between the two. If I generate this much cash, that's the cash I have to pay out. If I need to borrow cash, I have negative cash to fund the operations, this is where it has to come from. Saying the same thing in a slightly different way. If I'm paying cash out, I had to generate cash up here in order to pay it out. If I'm borrowing cash here, I'm putting it into the business so I can make investments here. So that's the way that we're going to start thinking about the model. And so essentially, this then becomes a very important graphic because this is the overview of our process. So as I mentioned, in other classes, this middle step is skipped. And we're not going to skip that step in this class. And what I mean by step is we're going to start out with accounting statements, income statement and balance sheet. And rather than directly predicting the cash flows, we're going to translate the income statement and balance sheet into this 4-box format. So we're going to take the accountant's format and we're going to rearrange it, and we're going to end up with the Modigliani-Miller format. So we're going to remap the statements to the cash flows to those boxes or buckets. What's very important is that the statements, when we rearrange them, still have to balance. So I have the same balance sheet. It's in a different order, but it's ultimately going to balance. I have the same net income. It's in a different order, but if I added everything up, I'm still going to get the same net income. And one of your frustrations with this homework assignment and your midterm exam is going to be making sure that all of these statements stay in balance. So as a process step, what we're going to start out with in the economic conversion is I'm going to arbitrarily pick the balance sheet. And it doesn't matter whether we start with the balance sheet or the income statement. We can do either one independently, but you need to do both statements in order to do the statement of cash flow, what we're going to call CFI in this class. So you have to have converted and gotten to balance the income statement and balance sheet. Then we create the cash flow from the income statement and balance sheet, right? Because remember, cash flow is cash from the income statement minus change in the balance sheet. That's our basic definition of cash flow. So using the 1, 2, 3 format, 1 is just a proxy for operating. So I'm going to take all the balance sheet items, assets, and liabilities that I define as operating. I'm going to net them out, and that's going to be called invested capital. So when we talk invested capital in this class, and this is an important distinction, we're going to be talking operating invested capital. And what that means is the part of the balance sheet that's being used to fund the actual operations that are supporting sales to customers. So invested capital in this class is operating. It's all the operating assets minus all of the operating liabilities. Now, I want to make an important distinction because Bloomberg and the rest of the world has a slightly different definition of invested capital. Matter of fact, if you go to Bloomberg, and I hope I'm still online, I didn't get kicked off here, and I'm on Delta Airlines. One of the things that I can do, and again, I'll go back to the main screen here, is I can go under what's called financial analysis. And the very first thing I'll see under financial analysis is a calculation of enterprise value. And so when Bloomberg calculates enterprise value, what they are doing is they are taking the debt and the equity and they're adding it together and they're subtracting out the cash. So this is called net debt plus equity. It's a traditional way of valuing the business. Now, conceptually, going back to our PowerPoint, we're doing it a little bit differently because I want to go back to this model. What Bloomberg is trying to do, debt plus equity is what's called enterprise value. But Bloomberg and the rest of the world subtracts out cash, which is a proxy for non-operating assets. So if you really think about what a Bloomberg enterprise value is trying to do, it's taking debt and equity, subtracting cash, and saying that's equal to the operating value of the firm. The one challenge with this in the world today is cash is not the only non-operating asset that firms have. That firms have joint ventures, firms have investments in other firms, firms own a lot of real estate assets, firms have a lot of things that are non-operating. And so therefore, the definition of invested capital that we're going to use in this class is a little bit more formal than the definition used in the real world. And again, I'm not going to say one is necessarily better or worse. They're different. But one of the things I want you to fully understand as we go through this process is why they're different between the way that the cash flows are set up and then what you're actually trying to analyze. So when you see an ROIC in Bloomberg, it's not going to be the same as an ROIC that we calculate in this class. And that's just sort of an important point. So again, I'm going to pause here before I go forward. Does that make sense? Questions? Okay, since I hear crickets, we're going to go forward. All right, so I take everything that we label as a 1, everything that we label as operating, we net it. It's called invested capital. I take everything that we label as a 2, non-operating, net it, non-operating cash flows, non-operating assets, net of non-operating liabilities. McKinsey didn't really come up with a name for that. I add the two together, and it creates something called TFI, total funds available to investors, or total funds invested for short. Recognize this is not a GAAP statement. This is actually a McKinsey consulting firm statement. It's an economic statement. And that equals the cash flow to the debt holders. And what we're going to define to cash flow to debt holders is anything with an interest rate attached to it or an implied interest rate attached to it. That's why, for example, leases were added in, or pension liabilities would eventually show up here. And then what we're going to do is we're going to add in the equity cash flows. And so anything that's labeled equity on the balance sheet goes here. So anything operating, non-operating, debt, equity. This is the rearranged balance sheet. And it still has the balance. It's called TFI. We're going to do the same thing with the income statement. We're going to map to the Modigliani format the income statement. What's called operating is called NOPLAT or NOPAT. It's the operating profit after taxes. We're then going to add in any non-operating items off the income statement. So we're going to look at the income statement for anything operating, which we'll label as a 1, put it here. Anything non-operating off the income statement, label a 2, put it here. We'll add those two items together. That creates something called TII, total income available to investors. And that will then equal to the amount that goes to the debt holders, interest expense, the 3s, plus the amount that goes to the shareholders, net income. 1 plus 2 equals 3 plus 4. Once we have put, and then you'll see the elegance of doing it this way, everything into the Modigliani format, then things become very straightforward. Because now we go to statement number 3, which is the cash flow statement. And it's called CFI, cash flow available to investors. Cash profit from the income statement minus investments in invested capital in the balance sheet, so change in the balance sheet, is something called free cash flow. That's the operating cash flow of the firm. Non-operating income minus non-operating investments in the balance sheet is your non-operating cash flow. Add the two together, CFI. That's the cash flow that can be paid to the debt and equity holders. What's being paid to the debt holders? Any payments in interest, any repayments of debt. So interest minus debt is basically the cash flow of the debt holders. Any payments to the shareholders, dividends and share repurchase, cash flow of the equity holders. That comes from the CFI. So the statement balances, but more importantly, it's broken out in these 4 buckets. When we do the valuation, we forecast the free cash flows, operating value of the firm. Forecast the non-operating cash flows, non-operating value of the firm. Add the two together, enterprise value. What we could do is we could forecast CFI directly, but we're not going to do that. We're going to forecast these two to get enterprise value. And by the way, that'll tell us how much debt we have is the same thing as forecasting the debt cash flows, and how much we can pay the shareholders is the same thing as forecasting the equity cash flows. So once we've mapped, the valuations are straightforward. So is the analysis. One of the keys to our analysis, ROIC, profit over invested capital. We already have the data to do the operating ROIC. We have the data to have the free cash flows. Matter of fact, I can get a return on my operating investment. I can get a return on my non-operating investment. And I can get an average return on the business. So by doing it in this method, that's what I said, it's a little bit extra work up front, but everything afterwards is clean and it makes the analysis more straightforward. Again, I'm pausing. Questions? Okay, great. All right, so that's what the video talks about. And so the video gives an example of, and please watch the video if you haven't, that walks through these slides of how we convert these statements. How do we go from the balance sheet and income statement to these statements, and how do we go to the statement of CFI? By the way, that is going to be your homework assignment for next week. It's worth 5% of your semester grade. And by the way, that's also going to be half of the midterm coming up in 3 weeks. So if you really don't understand this process, you're going to completely struggle on the midterm, because all the valuation work we do in the second half of the semester is built on your understanding of these converted statements. So what I want to do is, since already this process is fully explained in the video, rather than regurgitate what's in the video, I want to kind of go through a working example. So I posted to Canvas under the Files section a practice conversion and the solution to the practice conversion. Okay. So, and I strongly encourage you to try the practice without seeing the solution. But in this case, I'm going to pull up the practice conversion, and then I'm going to basically go through this as an example. And unfortunately, I forgot to put up the Excel model. So very quickly, I'll give you on your homework assignment the actual, tell you what, just because the interest of time, I'm going to go a little bit more complex. Last semester with my undergrads, I gave them a practice conversion that was a practice midterm. And I'm going to go through the practice midterm. This will help you with your homework assignment, by the way, this week. And by the way, if you can do this, you'll be in good shape for the midterm. So this is an income statement and balance sheet. And what I'm going to do, in the interest of time, if anybody's following along at home and wants to see this, is I'm also going to put this on Canvas. So this practice midterm file, I'm going to upload, or at least try and upload. Well, I didn't upload, probably because I'm in it right now. Try and upload to Canvas. Or not. Files. I guess because I'm in the file. Sorry. In case anybody wants to download and follow along with what I'm about to do. All right. Again, 443, spring practice midterm. All right, so the file that I'm about to use is there. What I've done for your homework assignment and what I will do for you through the midterm is I'm going to give you basically an Excel file which is a fairly basic income statement and a fairly basic balance sheet. And then I'm going to give you a couple years, in this case, there's 3 years worth of data, and then I'm going to give you the labels. So one of the first things in the process is that you have to categorize everything as operating, non-operating, debt, or equity. And to make your lives easier, right now, I'm going to give you these labels. But after the midterm, when you deal with real companies, you're going to also have to figure out what some of their items are. So this is just kind of practice to help us understand this. So as I said, I'm going to start with the balance sheet arbitrarily first, just to be consistent with the YouTube video that I made for the class. But basically, I need to convert this into a statement of TFI. So what I'm going to recommend that you do on your homework assignment is you create one tab per statement. So rather than trying to do all the conversion in one tab, you have a different tab or worksheet for every statement. It'll also make the copy and pasting far easier. So I'm going to create in Excel, new tab. I'm going to call it TFI. I'm going to blow it up a little bit bigger on my screen just so it's easier to see. So the key to TFI is anything that's operating is going to be part of invested capital. So in this case, anything that's labeled what we call a 1 is part of invested capital. So I want to look through my balance sheet and I want to put all my 1s together. So assets that are 1s would include, for the years, that's also why I recommend tabs. Copy and paste this over. 2007, 2008, 2009. The first one is cash, plus my second one is receivables. My third one is inventory. My next one is PP&E. My next one is goodwill and intangibles. And my liability ones are accounts payable. So what I need to do, copy and paste over. I do recommend also pasting the labels. Quickly paste, is I want to take everything that's an asset, add it together, and then I want to take anything that's a liability and I want to subtract it. So I'm netting my assets against my liabilities. And so in this case, that is what we're going to call invested capital, or what I would call operating invested capital, because it's the assets that are operating and it's the liabilities that are operating. And I can quickly copy and paste this over. So for this hypothetical company in 2007, their invested capital, or what they've funded their operations with, 2480. And then what I need to do is I want to add to this anything that's non-operating, anything that's labeled a 2. In this case, off my balance sheet, the non-operating items are excess cash. The next non-operating item is equity investments. And I look on the liability side to see if I have any 2s. I do not. So those are the only 2s that I have for this company. I add them together, and that's my non-operating investments. And when I add both of those together, TFI. So TFI is really the sum of the operating and non-operating, 2760. Right? So what I've just done is I've taken the balance sheet and I've broken it into the operating items of the balance sheet and the non-operating is in the balance sheet. And that's what we're calling the total funds available to investors. Now, what I then need to do is take any debt that I have, short-term and long-term, anything labeled a 3, and then I need to take anything labeled a 4. Common stock, retained earnings, and treasury stock are my 4s. Put them here, and then I sum my 3s and my 4s. And if I did not make a mistake, then I balance out. So here's what I know. I've invested in 2007 operating and non-operating investments of 2760. I put 2480 into operations. I put 280 into non-operating activities, requiring a total amount of investment in my business of 2760. In terms of debt, 760 came from the debt holders. The remaining 2700 came from equity sources. So again, I now have a cleaner representation of my reorganized balance sheet, not in the accounting format, but mapped to the Modigliani-Miller model. Questions?
Professor, just so I guess I'm clear, if there were any two liabilities, you would deduct that from, you would do the same process we did for the invested capital.
So let's say I have, and this is exactly what you're going to have on your midterm, so it's a great point. Let's say I have a non-operating liability. Now, typically in a balance sheet, they're not listed as negative numbers or listed as positive numbers. But let's say it was 100. Then what I would do is I would take that amount and then I would subtract a non-operating liability. So my TFI would go down by 100 because I invested this in my assets, but I got that amount of free financing. Right? And I say free financing because anything with an interest rate attached to it, we're going to consider on the debt side. So liabilities that don't have an interest rate attached to it are either operating or non-operating. But that's exactly how you would do it. Other questions? Right? I'm going to undo this because, and actually I'm going to redo this because here's another point. This is why, and you'll hear me say this in the assignments, I need you to do both methods and they need to balance. And what I mean by both methods is that I need you to do the 1s and the 2s and the 3s and 4s, and you got to get the same number. The reason why that's an important process is should be apparent right here. I made a mistake because if this doesn't balance that, if my 2760 on my liabilities and equity side doesn't balance the asset side, then my balance sheet doesn't balance, which means I forgot to do something, which means I actually have an incorrect answer, which means I have an incorrect valuation. So one of the reasons in this class I make you do balancing statements is it's really kind of just good financial hygiene, is that if you just forecasted free cash flow and then you didn't balance where the cash flow went, you really never know if you forgot to put something in the free cash flow. But if you forecast free cash flow and you forecast CFI and you track where all the cash went and it matches, then you know you didn't forget anything. And so it gives you better valuation methodologies. So I'm not saying that once you leave this class and in the real world or another class that you're not going to keep taking shortcuts. But that's the other thing. I want you to know that you're taking a shortcut. So for purposes of your grade in this class, you're not going to be able to take the shortcuts. You got to show me that both sides of this equation continually balance. So just giving me the right number is actually not a fully correct answer unless you can show me that both sides are balancing to that right answer. And that's actually going to be key for the grading. So if you don't get it to balance, you won't get full credit, even if one of your two numbers is right. Okay. So what we've just done relatively quickly is we've created this sort of balancing statement of TFI. Second, we're going to do the same thing with TII, total income available to investors. Again, I'll make it a little bit bigger so it's easier to see. Again, I'm going to copy and paste over the dates. I'll just copy and paste, make it easier. And then I'm going to follow the same 1, 2, 3, 4 process. Everything on the income statement was already labeled for you as a 1, 2, 3, or 4. So what I want to do is I want to take my ones and kind of group them together just like I did on the balance sheet. Now, in the video that I did that you'll watch on YouTube, I'll say there's a couple shortcuts I'm going to allow you to take this semester. And one of them is that since EBIT or operating profit is basically everything above it, revenue minus operating expenses minus depreciation, to save a little time, I'll let you start out with EBIT or operating profit or operating income on your TII. So in this case, the operating item is EBIT. So that's how much cash profit from the operating perspective this company is earning. And this is another point about the video. I then need to look at my taxes on my EBIT. And so what we're going to do with taxes is rather than just look at taxes as one number, we're going to split out the tax impacts to each area. Now we're going to end up with the same taxes that the company paid, but we're going to actually look at the taxes in a slightly different way. So if the company reported 300 million, let's use millions, in operating profits and had no other deductions or no other sources of income, and the tax rate were 25%, and that'll be an assumption I'll give you on your assignment, then 300 times 0.25 would be the taxes that they pay, which means that their no PAT or no PLAT, which is their profit after tax from operations, net operating profit after tax, equals the 300 minus the 75. So ultimately, when we do the ones, what we care about is how much profit do you make from operations on an after-tax basis. That's what's called no PAT, or McKinsey calls it no PLAT, which is net operating profit less the adjusted taxes. These are the adjusted taxes. Note, they're not the same taxes as the taxes the company's reporting on the income statement. It's taxes based on what they would pay on their operating earnings. Pausing. Questions? All right. So I then look at anything that's a 2. In this case, for my 2s, I have non-operating income, and that's my only 2 on the income statement. So what I'm going to do is I'm going to pay, that's my non-operating income. Copy, paste this over in my TII statement. Now, again, think about it independently. If I reported to the IRS $18 million of non-operating income, and my tax rate was 25%, then my taxes on my non-operating income would be 18 times 0.25, which means my after-tax non-operating income would be my pre-tax minus the after-tax. Now, you'll notice in the book that McKinsey consistently jumps right to the after-tax number. And I'm showing you this because I want you to understand that eventually you get lazy when you do this for a living, but it's perfectly acceptable in your assignments. It's perfectly acceptable and probably helpful when you're working on your exams to do exactly what I just did and write out the tax impact rather than just going straight to the after-tax non-operating income. But that's the point. On an after-tax basis, this company generates 225 from operating activities and 13.5 from non-operating activities on an after-tax basis. And when I add those two together, that becomes the income available to pay to my investors, the debt and equity holders. That is my TII. And so the next part is, how do I distribute this TII? Right? And I'm going to distribute it to the debt and the equity holders. So I'll start out with the debt. So in this case, from my income statement, my debt distribution is the interest expense, anything labeled a 3 on the income statement. So in this case, I pay this much interest. Except I don't actually pay this much interest because I get a tax shield. And the tax shield says that the government will allow me at a 25% tax rate to deduct 25% of that from the taxes that I pay. So that is my tax shield. Now, here's the other tricky part. And I say it's tricky because it's just a different way of doing it. The statement has to reconcile, which means the total income available to investors has to be the total income that's actually paid out. And I don't really have an easy way of explaining this other than to say that on what's called the financing side of the statement, the 3s and the 4s, or the funds flow side of the statement, and you'll see reference to this in the book, then payouts are positive numbers. And the reason they're positive numbers is we're reconciling that I have, and I'll use millions, 238.5 million to pay out. And that is the money that I'm actually giving to the debt holders. So I need to actually flip the sign on this statement so that interest expense turns into a positive number, because I'm paying it out to the investor. And what I'm reconciling is to the profit that I can pay out. And it's just a different way of thinking about the statement. So as I said, accounting is going to make it difficult for you to first start with the statements because these aren't based on accounting rules. These are based on reconciling cash flows in both directions. So in this case, I have this much income, I can pay it out. This is what I paid to interest holders. This is what I saved. This is my after-tax interest expense, which is the pre-tax interest minus the tax shield. Then I paid to my shareholders. Well, if I go back to my income statement, I look for anything as a 4 that I paid to my shareholders. In this case, net income. Now, you'll notice that on this statement, I list dividends. Very important. Dividends are actually technically not part of the accounting statement of net income because net income actually stops at net income. So the accountants actually stop at net income, and dividends is just the cash that's going to the shareholders. So even though I've labeled dividends as a 4, because it is an equity cash flow, and we will account for it in the cash flow statement, when we rearrange the net income statement, statement of profit and loss, we actually stop with net income because dividends is actually not part of net income, comes after net income. So just very important when you're doing your assignments that you stop at net income when you do the TII. Because if you throw dividends in there, you won't get your statement to match. So back to TII. If I take what I pay to the debt holders and I take what I pay to the shareholders and add them together, notice that it balances the income available to pay to the debt holders, the income available to pay to the equity holders. So here's my TII. So again, here's the profit from operations. Here's the profit from non-operating activities. And that equals the cash that I can pay to the debt holders and the cash that I can pay to the shareholders. The two sides balance. I mentioned the taxes would reconcile. You'll notice here we paid 70 in taxes in 2007. Well, let's look at our taxes. We paid 75 in taxes on this income, right? But we got a tax shield. Sorry, that's going to lower it. But before we lower it, we paid 4.5 in non-operating taxes, 79.5. 75 plus 4.5, we paid 79.5 in taxes, operating and non-operating taxes. We got a tax shield of 9.5. That's a savings. 79.5 minus 9.5 is 70. So even when we rearrange, we actually end up with the same taxes that we paid. But now we're looking at taxes by area. So I know that this is what I am really getting as a cash flow from operations. Whereas if I use 70, which a lot of people do as a shortcut, then it's mixing debt shield tax impacts, non-operating tax impacts, and operating lumped together. So again, what's very important in the model is we want to put it cleaner into each one of those areas. And so that's, again, reinforcing why we're using this format and why we're putting the statements into this format. Because now we're clean. Operating cash flow impact, non-operating cash flow impact, debt cash flow impact, equity cash flow impact, mapping back to the model. Questions?
I know there's other examples or solutions on Canvas, but are you going to post this solution file as well?
The one I just worked on?
Yeah.
You mean in class?
Yeah.
I'm going to post the solution file with no formulas. So I'm going to take it and I'm going to save it as just pure numbers. And then I'm going to post it. Because I want you to actually build it yourself when you do homework too.
Okay.
Because if you just plug and play what I did into my model, it's not going to help you. Now, I'm going to leave this video up, and I'm actually recording this entire lecture today, and I'm going to post it as soon as we're done. So you can see what we're doing on screen, but I don't want to just give it to you so you can just plug the numbers in, because then you won't really know what's going on. I think it's very important that you actually try and come up with the solution yourself for homework too. Other questions? Okay, so these are the easy statements. Now I'm going to go to the hard statement. I'll warn you in advance, you're going to struggle with this based on experience in the past, at least at first. This is the statement of what's called cash flow available to investors. Now that we have the rearranged income statement and balance sheet, we want to translate it into cash flow. Again, in this case, for the same number of years. So, how do I do this? I want to go back to our PowerPoint to make sure that you conceptually understand what we're about to do. That's why this graphic, I think, can be very useful for you. So what we've just done is we've rearranged the income statement and balance sheet into TFI and TII. Now we're going to create the CFI, the cash flow statement. Cash flow is cash from the income statement minus change in the balance sheet. That's just a conceptual definition of cash flow. It's what cash I make in the income statement. It's what cash minus what cash I rearrange in the balance sheet. And what we're going to do is we're going to go through that process 4 times. The cash that comes from the income statement minus the cash that gets reinvested in the balance sheet is called free cash flow. The cash that comes from the non-operating items of the income statement minus the non-operating items that come in the balance sheet is non-operating cash flow. The debt cash flows in the income statement and the change in debt in the balance sheet is the debt cash flow. The equity cash flows from the income statement minus the change in equity on the balance sheet is the equity cash flows. So we're going to go through income statement minus change in balance sheet 4 times to create the statement as CFI. So we're going to start out with the ones. So again, from the income statement, what are my ones? My first one from the income statement, TII, is my NOPLAT. That is the cash coming from the income statement, except it's not cash. And the reason why it's not cash is because accountants subtract depreciation when we calculated non-operating income. So to look at the cash impact, we have to add back depreciation. And that's going to get us something which is called gross cash flow. And just so I'm adding it back, I'm just going to subtract this negative number here so it just looks cleaner. So it's a positive 200. So my gross cash flow is actually 425. And these are both ones. Right? That's the cash from the income statement. What I then have to do is I have to then subtract in the cash from the balance sheet. So that is called gross investment. Now, what I'm going to do is I'm going to show you the shortcut for gross investment, and I'm going to show you the detailed way to get there. Right? What is the shortcut? The shortcut is equals the change in invested capital. So current year minus previous year invested capital. So that's how much my invested capital increased. That's the cash impact. Plus depreciation. So that is my gross investment. Free cash flow is gross cash flow minus gross investment. That is the operating free cash flow. Of the firm. Oh, I know. Sorry. One other point I forgot to mention is that because we're looking at the change in balance sheet, I actually can't do 3 years of free cash flow. So actually, just clear these cells. Since it's a change in the balance sheet, I can only do the current year. So technically, I'm just going to cut and move these over. This is the gross investment for 2008 because it's the change between 2007 and 2008 in gross investment and 2009. So this is my free cash flow for 2008 and 2009. Because I need a change in balance sheet, I can do 1 less year of free cash flow than data available. So if I give you 3 years of income statements and balance sheets, you can do 3 years of TII, 3 years of TFI, but you can only do 2 years of CFI and free cash flow because you need the change in the balance sheet. All right, so there's my free cash flow. Now, I also want to show you granularly how I get the same gross investment. So gross investment is anything on the balance sheet that's changing. So what's really changing is, in this case, go back to my TFI. I've already labeled everything that's a 1. It's all of these items that are changing. Now, you don't have to do this technically for your homework assignment, but it'll be a helpful process to do in the future, which is to put all of the current ones together and then put all the long-term ones together. So we create the concept of working capital and longer-term investment, because later we're going to forecast working capital separately than longer-term investments, as opposed to just forecasting a growth in one item for the balance sheet. So basically, I take all my short-term ones and put them together. So in this case, operating cash is a short-term one. Try this again. Is a short-term one. Receivables is a short-term one. Inventory is a short-term one. And accounts payable, if I had any, would be a short-term one. So that I get what's called operating working capital. And again, I'll use the word operating working capital, and unfortunately, I'll probably call it working capital throughout the semester, but it's actually not the same as the accounting definition of working capital. And operating working capital is going to be all my operating ones minus my non-operating ones. Right? And here's the difference. When we call operating working capital, accountants call current assets minus current liabilities. Here's the difference. Current assets include excess cash. We're stripping that out because that's non-operating. Current liabilities include short-term debt. We're stripping that out because that's a debt equivalent cash flow. So the accounting definition for working capital and the definition we're using here are actually different because we're actually breaking out things into operating, non-operating, debt, and equity cash flows, and the accountants don't care about that. So in terms of source of confusion for you, make sure you understand that that's one of the differences we're doing here. So this is my operating working capital. Right? Does that make sense? Okay. Now, technically, what I could do is on my statement of TFI, that's where I probably should have created it. Right? But I'm just showing you how you could have done it on the statement of TFI. You could have created your operating working capital. So then what I would do is I would have, insert more space here. Then what I would have is I would have my long-term items, which would be PP&E and goodwill intangibles. Copy, paste. All right. So now I want to talk about gross investment. So my change in working capital equals current year minus previous year. My change in PP&E is called CapEx. Well, capital expenditures is net PP&E this year minus net PP&E the previous year plus the current year's depreciation. I then have a change in investments in goodwill and intangibles equals current year minus previous year. Notice, where did I screw up here? disadvantage of doing this messed up in real time.
I think
I
you
may-
used the wrong depreciation at the top
Did I?
when you moved it over on your last one, I think.
Oh, okay. I'll take the, let me check that. The capital expenditures, B12, C12 minus B12. We'll think of it this way. In order to go from 200 to 2020, 200, I would have had to spend 220, 2000, 420. Is that right? Oh, B7, 1, 2, 3, 4. What am I missing?
Yeah, I think
Operating
the
cash.
formula is not right in the gross
Inventory.
investment.
I'm sorry?
The formula is not right in the gross investment calculation. So when you add up the depreciation, you do not add up to 2008. I think you add up to 2007.
Okay, so gross investment is, sorry, thank you. It's B3. Oh, you're right. I didn't do, it's now, the depreciation is in the wrong year. So the depreciation is not in column B, it's in column C. So C3. So 390, 390. By the way, this is an excellent example that we are all fallible in doing this. And this is where it gets a little tough. And that's why I recommend doing things using what I call both methods. Because when you take shortcuts, you can easily make a mistake and you don't even realize you made a mistake. But when you have to get it to balance and you make a mistake, and I know it'll be frustrating, but at least you know you made a mistake. And then you can quickly start to identify the reasons that you made the mistake and then correct it. So again, thanks for giving that quick assistance here. But that's the point, is that the gross investment using what I'll call the shortcut method has to equal the same gross investment in granularity, right? And so I find it helpful to do both methods. Now, again, I'm going to wipe all this out. I'll give you a solution later that has all of it in it. But just to keep the statement simple and clean, that is my free cash flow. That is the cash left after my investments back into the business. And that has to equal, that has to be then added to my non-operating cash flows. So equals TII. And again, I need 2008 and 9 are going to be the areas I care about, but it's easy to just copy and paste all three. Then I need my after-tax non-operating income is my non-operating cash flow. Because again, everything is going to be tax impact. That's my only two. And then that becomes, when I add that to my free cash flow, my CFI. My cash flow available to shareholders. Right? And so let's just think about what's happening here. So basically, in the year 2008, this company is generating cash that can be paid out to investors. In 2009, this company actually needs financing from the investor in order to continue because it has a cash deficit of negative 300. Now, why does it have a cash deficit of negative 300? We can kind of see through the granularity. It's because their gross investment exceeded their gross cash flow. Whereas in 2008, their gross cash flow exceeded their gross investment. So that's the point. I spent more than I took in, which caused me to have to borrow money, right? That's something that when we put everything into this format, when we start doing analysis, we'll start to become more clear about what's really happening here with the company that just by looking at an income statement and a balance sheet, I wouldn't necessarily be able to see. So this is what's called the cash flow available to investors. This is the cash that I could pay out. This is the deficit that I need to raise, right, from my debt and equity holders. So now I'm going to go to the other side of the statement. I'm going to do the funds flow. So again, from the income statement, skipping processes left and right. That's my CFI if I ignored the balance sheet, and I can't ignore the balance sheet. So I actually have to look at the impact of investments and non-operating items in the balance sheet. So on my TFI, don't skip this step like I was about to do. I had excess cash, and I had equity investments. And I accidentally added this one due to the question, so I'm going to just wipe that out. All right, so those were the two non-operating items on my balance sheet. So same idea, change. So in this case, excess cash went from 230 to 249. So excess cash increased by 19. Now, I don't have a simple way of answering this one, except make sure you watch the YouTube video because you get some further explanation. But we have to think about what's actually happening here with the cash balance. And the example that I used in the video basically says you should think of operating cash as cash in your checking account that you use to pay your bills. You should think of excess cash like money you're storing off in a mutual fund or an investment fund to make investment income. Except the investment fund doesn't actually let you pay bills. So if I put money in Fidelity, I can't pay bills. Now, Fidelity lets you pay bills, but just kind of go my metaphor. The idea is that operating cash is what I'm using to actually run my business day to day and pay bills. Excess cash is just money I'm putting into savings account. Think of it that way. So the point is, if I increase my savings account by $19 million, I'm taking away from the money that I can pay to my investors. So the actual impact is that it is going to reduce the cash flow that I have available to pay to my investors. If my equity investments grow, so I went from 50 to 300 by 250, then my equity investment spending 250 is going to reduce the cash flow that I have to pay to my investors. So ultimately, when I sum up my CFIs, that would be my CFI and can't maybe so for the 2 years. So I'm actually running a deficit for both years when I threw in the balance sheet impact, because even though we saw for this year they were running a surplus originally, that's before they put money into their savings account, and that's before they made an investment in a non-operating asset by buying a stake in another company. Here they sold a stake in another company. You can clearly see that because the equity investment went down, and that generated some cash, which could then be used to pay the investor. So the situation would have been worse in this year if they hadn't have had this extra cash to pay out. Right? And so that CFI has to equal the debt and equity equivalence. So let's talk about the debt. Who am I paying out? I'm paying out the debt holders on the interest on the income statement, TII, after tax interest expense. And then change in debt, change in short-term debt, change in long-term debt. So my short-term debt went from 0 to 240, so it increased by 240. My long-term debt went from 760 to 920, so it also increased by 160. Now, if I think about this, if I increased my debt, I borrowed money. The reason I'm borrowing money is to finance negative cash inflows. So the sign of an inflow is a negative on this side of the statement. So I actually have to flip this sign because I have to represent a cash inflow into the firm by borrowing cash from my investor. Whereas a interest expense is a payment to the debt holders. So that's a positive number, and it's a positive outflow because I would pay them if I had positive CFI. So in this case, increases in debt are negative numbers. So we can clearly see for these 2 years, the company continued to increase its debt, though it paid some of the money back in the form of interest. Right? So that would be the debt cash flow. The cash flow on the income statement, the change in debt on the balance sheet. And again, we're reconciling back to the CFI. Now, the last part is equity. And equity is even trickier because there's two major things in the equity that are just basically rules of this statement you're going to have to be familiar with. So the first one is when we talk about the equity cash impact of the income statement, it's not net income. Net income is not the cash payment to the shareholders. And ultimately, what we care about is the cash payment to the shareholders. So even though we reconcile the statement of TII using net income, when we look at the cash flows that are going to the shareholders, it's actually the dividends. That's why I had to give you the dividends of the assignment. That's why we'll have to look up the dividends in a company's 10K and or on Bloomberg to figure out what the cash flow to the shareholder actually is. So on the statement of CFI, since we care about cash flow, instead of net income, what we care about are the dividends. That's the actual cash flow of the shareholders. And that's just a tricky part of this statement that you could ultimately struggle with. So basically, I forgot to put I like to keep my labels here so I see all my 1s, 2s, 3s, and 4s together. So again, because a dividend is a cash payment to a shareholder, it's a positive number. Right? Because again, payments are positive numbers. Change in the balance sheet. We have 3 balance sheet items. Common stock, retained earnings, treasury stock. So in this case, I want the change in common stock. I want the change in retained earnings. I want the change in treasury stock. And by the way, I'm making an intentional mistake to prove a point. Quickly tell me as I go through this where you think the mistake is going to be, because I'm going to show you how this mistake will cause this statement to cause problems. All right, so change in common stock equals current year minus previous year. Same thing for retained earnings and the same thing for treasury stock. Right? Now, I had to think about my signs. If my common stock, and it didn't in this example, but let's say it increased by 100, then that would be taking equity to the firm by selling shares. Just like debt as an inflow is a negative number, an increase in equity to the firm, getting cash from the shareholder, is considered a negative number on this statement. So I would have had to flip that sign. Retained earnings, I also would have to flip the sign. And change in treasury, I have to flip the sign. Because if I pay out cash to shareholders by buying back their shares, that's what an increase in treasury stock is, then that is a cash flow that is going to the shareholder. So ultimately, those were the 3 balance sheet items on my TFI. And now, when I add up all these cash flows, I need to get this statement to balance. And I told you I was intentionally making a mistake. So there's clearly a mistake because the CFI from the operating and non-operating side does not balance the CFI on the funds flow side. So does anybody know where I made my mistake?
Did the retained earnings?
Why is retained earnings a mistake?
It's not a cash item.
That's right. That's the second tricky part of this statement. So the first trick is that net income is not the cash item. That's a cash flow of the shareholders' dividends. On the balance sheet, a change in retained earnings is a change in a non-cash account. So even though on the statement of TFI, to get the TFIs to balance, we include retained earnings, on the statement of cash flow, the CFI, we do not look at changes in non-cash accounts. So it's a mistake if you do. So I have to take out the non-cash account. So make sure I sum them up. All right. I made a mistake again. Not having a good day today. What else did I forget? Well, since we have about 5 minutes left in the video, go back to
You
my...
modified the common stock.
I'm sorry?
Modified the common stock.
Oh, thank you. But let me switch that back. I need to switch that back to 600. So there was no change in common stock. But I made a mistake on something else, and I got to remember what it was. And that's why I know. So again, in the interest of time, the formula. Let me go back to my CFI. 176, 77.5. So again, in terms of balancing, all right, 467.5, 467.5 and 550. That's right. 390 and 810. That's, oh, I know why too. My depreciation is in the wrong year as well here. 250 for the cash flow impact of the gross investment. There we go. So that will correct that problem. I put in the wrong place. And change of working capital, goodwill, free cash flow, negative 77.5 and 260. Sorry, when I was copying and pasting, I actually had the wrong cells. Because I deleted that whole section, so that was a problem. Anyways, assuming that you can put your numbers into the right categories and subtract this from this, then you'll get the right answer, which I was incapable of doing. And ultimately, as I said, these two sides balance. But again, great illustration because, and this is what you're going to struggle with on homework too, you got to get the two sides to balance. And if you don't, you know you made a mistake. And that's what I'm saying. I quickly tried to create this statement for purposes of this video, and ultimately I made a mistake. And again, I was sloppy. But here's the thing. If I didn't try to balance the statement, I wouldn't have known that I was sloppy. And again, I know it's frustrating, but it's very critical to balance these statements because that's the only way that you really know that you didn't make mistakes. And it could be even a simple mistake that I'm referencing the wrong cells when I'm copying and pasting in a spreadsheet. But I'm telling you, if you don't do this level of double checking in the real world, you get fired because you can't put the wrong valuation up in front of a corporate client if you work for JP Morgan Chase. It is completely fatal to their reputation. So it's good hygiene, good practice to work on if you're going to be kind of doing this as a professional as well. But ultimately, it's also important because it matches back to the theoretical model. All right, questions about any of that? All right, here's your last statement for your homework 2 assignment. You have to do an ROIC and an economic profit. So I'm just going to call it a tab. I'm going to call it economic profit. Again, it's going to be 2 years worth of data. So even though I have 3 years worth of numbers. And the reason why it's going to be 2 years worth of data, this again, copy the years, is I need to first calculate an ROIC to calculate the economic profit. So for ROIC, I need from the TII my NOPLAT, and I need from the TFI my invested capital. And that's going to give me my ROIC. All right. Now, here's the thing. What I'm going to ask you to do is something called BOY or BOY ROIC. BOY stands for beginning of year, right? Beginning of year is the same as the end of last year. And there's a technical reason why I'm doing this, which is if you use BOY ROIC in your valuations, then your valuations balance exactly. If you use end of year ROIC or end of year invested capital and average invested capital, then the DCF and economic profit valuations are close. So in order to get exact on your exams, we're going to use beginning, which is starting ROIC. Practically, what does that mean in this case? I take my 2018 8 no plat, and I divide it by my 2007 invested capital. So my ROIC for this company as a percentage is 10% and 11.3. I then need a WACC. I'm arbitrarily giving you a WACC on your exam. In this case, it's 8%. I will change it randomly on your exam, so don't just always hard code this number in. 8% and 8%. That gets me a spread. My spread is my beginning of your ROIC minus my WACC. Beginning of your ROIC minus my WACC. Right? So I have a positive spread for both years. What I then do is I take my beginning invested capital. So in this case, or sorry, probably easier to call it beginning of years to be consistent, equals the previous year's invested capital. And that gets me economic profit. Economic profit is spread times capital. That's economic profit, also called EVA. Now, there is a second method the book talks about. If I take my no plat and I subtract out what's called a capital charge, I also get economic profit. So I use the same no plat. Capital charge is the beginning of your capital, and I'm paying 8% for it, so times the cost of capital. Economic profit equals no plat minus capital charge. So I can calculate my economic profit, also known as economic value added, two ways. I can do it using what's called the spread method. I can use it using the dollar method. I get the same answer. So for homework 2, this is the process that you have to complete. Now your homework 2 is actually slightly less complicated than these statements, but the process is identical. And so by next Saturday, as an individual assignment, if you go back to Canvas and you look at the assignment tab under homework 2, you will see the assignment. It's already posted. I've given you a data file, just like the data file that I had. You'll download the data file. Everything's already labeled. You have to create the 4 new tabs, and you basically have to come up with the reconciled economic statements and the economic profit for those statements. That's what you have to submit as an Excel file before next Saturday. And next Saturday, we'll talk about analytics. How do then we make meaningful sense out of this numbers, and what does it tell us about the companies? And then we'll probably seed some real examples of real world companies in this format. But again, it'll be very helpful for you to understand how to actually create these statements so you'll know what the data that you look at is all about. Final questions as we wrap up.
Professor?
Yes.
Can you just elaborate a little bit on the negative sign you put in the CFI tab?
Sure.
Why we put negative, why we put positive?
Well, as I said, conceptually, and I, unfortunately, like I said, my webcam isn't working, but the way I would show it to you in class is if I had $1, then I need my statements to balance. So if I have $1 and I pay you $1, then this side of the statement should be $1, and this side of the statement should also be $1 because I need my statements to balance. But if I treated this as $1 and I treated this as negative $1, my statement wouldn't balance because I'd have 1 on this side and I'd have negative 1 on that side. So in order to get the statement to balance, what McKinsey did when they created the statement called cash flow available to investors is they said, look, this is the cash that I generated from these two activities, and that has to equal the cash that I'm paying. So if I generate a positive amount, I pay out a positive amount, so payouts are positive. If I have a negative amount, this is my deficit. This is the deficit of cash that I have because I spent more money than I took in. So therefore, my deficits have to be funded, and therefore inflows to fund those deficits are considered negative numbers because I'm funding the negative cash flow from operations. So what you can't think of is the GAAP statement of accounting cash flows. Like, this is not the statement of cash flows in accounting. That tries to reconcile changing cash balance, and that's not the intent of the statement. The intent of the statement is to reconcile, are you generating cash from operating and non-operating activities? And if so, what are you doing with it? Who gets that money? And therefore, positive payouts. If you have deficits in your operating and non-operating activities, where did the money come from? Negative inflows to fund the deficits. That's just the way the format of the statement is structured. But again, important question, because this is something you're probably going to struggle with in the signs. And so the most important thing, and that's why I want you to do the granularity, is if you think about each one of these signs, that ultimately you got to just think about the direction of the cash flow. Is it coming in? Is it going out? As opposed to just kind of hard coding in rules of thumb. It'll just help you as you create this for the first time. Other questions? All right, so again, next Saturday, we're going to have our normally scheduled class at the Reagan building starting at 2 p.m. I would strongly encourage you to take advantage of either on Canvas, under the Files section, there are 2 one-hour lectures that I did that were on video, and I put them up here as Conversion Part 1 and Conversion Part 2. That's basically the entire PowerPoint that we didn't have time to go through with a lot more detail. Or if you go to same files, if you go to the Pages section, you can see the links on YouTube for those videos. So if you want to access on YouTube, it's great. If you want to download the files or look on your device, it's your choice. However one, they're both the same videos. But you probably want to look at both those videos. You'll then need to go to the assignment, download that Excel file, and convert it. And you're also welcome to use what we just did here as I'll record this and post this to both YouTube and to the file section as well. So I will post the lecture capture, like I said, of this, which should have the video and the audio and the screen sharing. All right. Otherwise, other questions, feel free to contact me via email or potentially phone, but email is usually the easiest way. And again, I will look forward to seeing everybody in class next week at the Reagan building. But let me ask one thing before we all run away. In terms of feedback, sorry, I'm going to pause the video. We don't need this. So let me end the video capture. Or at least try. Of course,